Hello there and welcome. Can I start off by saying either a good morning or good afternoon or even a good evening, depending on where you are around the world. And thank you for joining me tonight on the latest episode of How I Got Into Trading. Tonight's episode is called How I Started to Learn Risk Management. Written by myself, of course, which is James Trescothick, and I'm the head of investment research here at Stratton Markets. Now, before we get on to an introduction on myself and tonight's agenda, clearly we're talking about online trading and CFD trading. And like with any types of investments, it does indeed carry a great deal of risk. So I do suggest you do your own research and your due diligence and know the risks at hand before entering any trade. With that out of the way, this black and white image, sultry figure, is myself. Like I said, my name is James Trescothick, and I'm the head of investment research at Stratton Markets. I have over 20 years experience in the financial service industry. I actually started out at the age of 18. I'm now 41 in May, if anybody's interested. I actually started off as a mortgage broker, where I specialized in commercial mortgages and buy-to-let mortgages before moving into the subprime market. I then moved into pensions and alternative investments, and then I got into, obviously, trading. I've traded myself, and I've ran a trading floor in the Philippine Stock Exchange, traded gold options for the Dubai Gold and Commodity Exchange in Dubai, and I moved into portfolio management and then education a few years later. So then altogether, I've been in the trading industry for about 14 years. I'm indeed a published writer, and I've been published in several leading publications, including the likes of the Financial Times Advisor, Market Watch, which is the Wall Street Journal, several newspapers and magazines. I'm an avid market commentator. I've been often approached to ask about my opinion on where I see the market going. And I'm very passionate about this marketplace. There's one thing I will say. I am very passionate about this industry and about trading in general. But I'm an avid market commentator, and I'm a well-known public speaker. And I've spoken at several industry events around the world in countries including Hong Kong, Singapore, Dubai, Kuwait, Qatar, KSA, South Africa, Joburg, Pretoria, Cape Town, London. Obviously, as you can tell, I'm a Brit. Berlin, to name just a few off the top of my head. Now, tonight's agenda, or tonight's episode, will be focusing more on risk management. Before I go through the subject matter, one of the things which I tend to find that so many people do not focus upon is risk management, because everybody tends to feel that there's a holy grail of an answer out there, which is, understanding maybe technical analysis, certain strategies, moving the average, crossover, understanding fundamentals. All those are a key part of understanding how to trade, but none of it would work unless you had a very good risk management program in place, because that's what the professionals do. They have their theories, they have their strategies, they have their overall view of what they believe in, what the intrinsic value is, or what the buying patterns are. But what stands out from the professional traders, to say the usual retail traders, is they don't have a risk management plan. Professional traders do. They know how to protect themselves. They know the secret is not earning the big bucks, is building portfolio over time, but the secret is not to wipe out your account. So tonight, like I say, we are talking about risk management, and the agenda is this. In a noisy world, why risk management is important. Then we'll be talking about defining what a risk management actually is, what it actually means. Then we'll talk about what makes up a risk management program. Then reward risk ratio, something again you need to have in mind when you're designing your plan. And of course, the usual ending of the episode, which will be up and coming educational events the rest of the month, and obviously my usual question and answer session. So, why is risk management important?
People join in the middle.
Let's face this. Okay, let's face the fact. The market is busy. First of all, we have our charts. We have our market rates going up and down, moving left, right, and center. We have our order ticket flashing at us, moving, telling us to either sell or buy. Then we have market news, latest developments, headlines flashing at us, instant market news coming at us. Then we have our financial calendar we have to follow. Then chuck that in the middle of that, our technical indicators, Bollinger Bands, RSI, moving averages, all these flashing stuff coming at us. Excuse me. We're human. We're human. There's an awful lot of information to take in. Awful lot of information which can actually drive us and maybe make us to do things because we get carried away because we're emotional and get lost. This is why risk management is essential. It's so important. Because it doesn't matter at the end of the day how talented you are or think you are as a trader. Even the trader with the most keenest eye for spotting the most ideal investment opportunity can still blow their account in one or two trades. And here's the thing. At the end of the day, you could still have 90% winning trades, but still be on the negative side without proper risk management. My whole point being risk management isn't designed to stop you from losing. But guess what? You are going to have losing trades no matter what, because losing is a part of trading. It's not to stop it. It's to control it. Put myself on camera so you can see me. My ugly face. You can laugh, Michelle. If you want to. Oh, there you go. You see me now? Oh, man. Yeah, I probably need a little bit more gel in my hair. A bit fluffy today. Anyway, let me move myself out of the way so I don't have to see myself, but you good people can see me. Anyway. And here's the most simple practice. I needed more gel, yeah? You think so, Michelle? Thank you. Oh, good to see you as always. I know, it gets floppy. I don't use enough wax or... Anyway, I'm too set in my ways. My hair is my hair. As long as I would tell it, Michelle, as long as you say it looks like Donald Trump, then I will shave my hair off. That's a promise. Anyway, my point being is risk management is really a simple process or an ideal to adapt into. Again, like I said, underline is not to prevent losing trades, because losing is part of trading. It's about controlling it. So what actually is risk management? like I say, risk management is put in place to take into account that you will occur a loss no matter what. The point of risk management is to try and protect your trading account from losing everything, wiping yourself out. That's the point. It's not to prevent loss, it's to control loss. Now, what makes up a successful risk management plan? Well, first of all, a trading system. Second of all, this is the hardest thing to conquer, is controlling one's emotions. Thirdly, money management. Now, an effective trading system basically really keeps to a strict set of rules, which could include such things like a specific entry or exit point, or in relation to a trend of an asset, whether or not you act on rebounds, breakouts, etc. That's your system. Once you develop that system, that's the system you stick to. At the same time, maybe you developed a plan where you've discovered that certain indicators happen to work for you and only work for you. You've got an eye for it. It works. Like, not everybody gets on with the RSI, for example. Not everybody gets the moving average crossover, or the MACD for that matter. But once you establish what does indeed work for you, you don't stray from it. You stick to it, no matter what. And this is one of the ways how you can discover your plan. And that is, on other episodes I've done this already, the importance of creating a trading journal. Now, a trading journal can be really, really simple. And I love the idea of a trading journal, simply because it goes back to the old-fashioned methods of trading. Back in the day, before online platforms, before the likes of this and the likes of that, you used to have a broker. If you wanted to buy some stock, you'll go through a middleman. You phone them up on a telephone, you will say, I want to buy, say, I don't know, Boeing stock, for example. I want to buy Boeing at 78.26. I want to buy this amount. I want to set my stop loss here, may take profit here, and then straight away after doing that, you put the phone down, you fill an order ticket, you'll go into the floor, and then you move away. And at the end of the day, you'd either have a winning trade or a losing trade. By doing that method, you wouldn't, okay, maybe you studied charts and the fundamentals, maybe you had a belief in reason why an asset was going up in price, but you weren't constantly looking at the screen to do it. You knew when you had your call on your chest, you decided what you were doing. This is why I quite like the idea of a trading journal. And the trading journal I try to suggest, or as an idea, can be simply a simple Excel sheet. Let me get my flashy red marker here, my laser pointer. The idea, give me some Excel sheet, and all you need is the columns. All you need is date, instrument, direction, long or short, entry level, stop loss, take profit, and your reasons, and obviously the outcome. Clearly, another thing would be another column saying contract size, one lot, whatever, etc. But the idea I like to try and suggest is that you fill in this box, this box, this box, this box, this box, this box, this box first before you click trade. The reason why I like this sort of approach is because straight away you've got your asset, You got your direction, entry, stop loss, take profits. So straight away you have your minimum amount or the maximum amount you're willing to risk, your target, and your reasons, which means you actually thought it through. You've done your research, you've done your due diligence, you've come to your conclusion, and you filled in all those boxes, and then you act. Because going back to the slide a few slides ago where we got the charts, the news, and all this come to us, we are so emotionally tied to it, but we don't actually really know why we're reacting. We're reacting because we're seeing something happen instead of thinking it through. And I like this approach because it takes a lot of the emotions away and you're thinking about it almost rationally, and straight away, I'll go around in circles on this, you have your risk management program in place. By doing this approach, you take away a lot of the emotions, which I think is one of the biggest battles retail traders have. Because, let's face it, when we start out trading, we all like to begin on demo accounts. We do, don't we? But here's the crunch of the matter. Trading on demo accounts is totally different from trading on a live account. And though when you're trading on demos, you might test some strategies because the rates and the fees should be the same. That's fine. But when you're trading on demo accounts, there's a massive difference. This is what, though it's a good idea to use demo accounts to test the platform, test a few strategies, to learn trading from demo, forget about it. It's never going to work. Why? Because it's totally different from trading on live, because you're not learning about how you react. Because on demo accounts, the money is not real, which means the emotions you go through are also not real. So how are you going to learn? Because this leads us to the biggest battle which every retail trader goes through, and this is the battle between fear and hope. Now imagine this. You have a winning trade in the market. You have a happy feeling. Of course you do. You're winning. You're making profit. But that happy feeling slowly disappears because suddenly you start to fear that any minute now, just to spite you, the market will turn against you and that happy feeling will disappear. So your automatic reaction is you get out, you snatch at that profit, taking a very small gain. There's a flip side to this story. And this is hope. This time, you have a losing trade in the market. Do you close it? No, you don't. Instead, you keep hold of that position, hoping that market will turn around in your favor. But it doesn't, does it? Instead, the loss gets bigger and bigger until you know it, you're either stopped out or your account is wiped out. This is the biggest battle every retail trader faces, the battle between fear and hope. Every single trader will go through this, no matter what they say to themselves, they all go for it. Look at your trades, talk to yourself, you know you will do it, and you're still doing it. Because if you generally look at the majority of retail trading accounts, or maybe even look at your own trading account, you might possibly see a large majority of winning trades, but your account is still in a negative balance. Because it's nothing to do with the amount of winning trades you have, it's to do with the risk management aspect. Now you can have like 70% profitable trades, However, if you are, like I say, unable to swap fear and hope around, and this is the whole point. This is the battle you need to do. When you have a winning trade, you need to swap the emotion. You go from get rid of fear and hope it will go higher. Maybe introduce trading stops, something like this. And when you're in a losing trade, you need to get scared that it's going to get bigger, have the fear, and close it beforehand before it gets bigger. Because, like I say, even if you have 70% profitable trades, if you can't swap those two emotions around, then the chances are the gains will be so much smaller than the losses, which will make your account negative. At the same time, if you can swap these emotions around, you could have 30% profitable trades. But because you're able to swap hope and fear around, that 30% of the trades will outnumber the losing trades. So potentially your account could be in a positive. It's what comes down to risk management, money management first. By managing your money will also, at the same time, help your trading plan, but also control your emotions. Money management will take into account the size of the position you open, the leverage you use, the stop loss you put in place, and your potential take profit level. The right money management program looks into the long-term gains, not the get-rich quick dreams and imposes strict guidelines. Like I said, I've said this a lot, that trading is not about making the quick money, it's about building your portfolio. So this is what really can help. Now, strict risk guidelines includes the following: the size of your position, hedging, hedging opportunities, correlations, recurrences, which I'm a big, I look into a lot. I do like that. Setting stop losses and take profits. So many people don't do that. Knowing when to accept the loss, like I say, it's not a case of preventing the loss, it's taking it and stepping away from it. So how do you calculate the right amount of capital to risk? First of all, the amount of risk per trade should be based upon how big your account is. The usual rule is 1% of your account balance on one trade. Now, this doesn't mean you can only open a trade with 1% of your account balance. No. What this means is that you can still use the amount you want to use in a trade as long as you set a stop loss, which is set to 1%. For example, say you have an account balance of, say, $30,000. You open a trade with a 29,000 as your margin to risk. But your stop loss is set at a maximum of $300, not the full 29,000. Again, open the size of the trade, but you're limiting your exposure. This brings you onto the whole risk-reward ratio. As I keep saying, and I've gone over and over again, every trader will have a losing trade no matter what. You will lose. But one way to strike the right balance is to try and use a risk-reward ratio of like 2 to 1 or 3 to 1. What does that mean? Basically, that means is that your take profit is set to what you're risking, and your stop loss is set at 1 or 3 to 1. The reason why we always suggest this, or not suggest this, why it's suggested for you to take on board, is that by applying a risk-reward ratio, your winning trades, in theory, should be at least double than your losing trades. Again, 70% losing, doesn't matter. 30% of your winning trades are more than you're losing does make a difference. But this is not really enough, just this on its own. You need to, again, be disciplined. This is the whole point in a risk management program, is so that you're disciplined. And I'll give you an example of this. Say, for example, trader A is aggressive. She or he uses 60% of his capital and sets a target of 120%. So again, that's 2. Okay. But trader B is less aggressive. He uses 5% of their capital with a target of 10%. Again, 2 to 1. The fact of the matter is that even though it's the same principles of 2 to 1, 60% is a huge amount of the capital to put at risk. And the target of 120% is massive to reach. Whereas trader B, again, is still using the same 2 to 1 parameters of it, but the goal is slightly more reachable. So the question is, which trade is more likely to be more profitable trading? Really, again, it's more likely the less aggressive approach because the parameters are not so large. Again, we're using the 2 to 1, but they're not setting their goals so highly. Up and coming educational events for April. Season of April, I'm doing episodes how I got to grips with Japanese candlestick patterns. Again, we're going back more technical based. 23rd of April is how I got to understand momentum indicators, technical based again. And finally, on the 30th of April, again, still technical, how I got to understand pivot points, and I will be sharing how to calculate them, just so that you know. If you wish to speak to me, of course, you can, as always, email me at james@strattonmarkets.com, or you can follow me at Twitter, Colin Michelle. Neither one of you have. Naughty. And my handle is at Trescothick. I often give heads up on new videos and educational stuff I'm doing and market stuff. So, and plus you can direct message me whenever you like. Before I go to questions and answers, of course, I'll be talking about CFD and online trading. And like with every type of investment, it does indeed carry a great deal of risk. I do suggest you do your own research and due diligence and know that risk is at hand before entering any trade. With that out of the way, questions and answers. I can see already I have a couple of questions. Right, brilliant question from Colin. Good to see you, Colin, by the way. Hi, James. A question about setting stop losses. The platform doesn't indicate how close you can set these. Okie dokie. Great question, by the way. Are you using the Stratton trailer, web-based platform, or MT4? Which one are you using? Stratton, the web-based. Okay. What's your usual parameters? Where do you usually set them? 20, 30 pips? What's your parameters to them? What's your usual, where do you set them usually? Okay, all right. So have you ever set a stop loss? Yes. Okay. Okay, and where do you usually set your stop loss? Do you have a set plan? Do you have a set amount? For example, if you're doing one lot. Okay, how close are you looking though? 5 pips, 10 pips, 20 pips? What pair are you trading? 2 times the spread. Okay. And what do you trade? Mainly. I haven't seen your account, Colin. I don't know what you trade. Too close to the camera, I'll look automatically. And weed. Okay. Okay. Sterling Swiss franc. Okay. Interesting. Do you ever do the euro sterling? I like that pair, personally. Just okay. DAX and Dow. Okay. I remember you do trade the indices, don't you? Okay. And what time do you trade them though? Do you trade them around certain market events? Because here's the thing, obviously trading conditions, they can alter during certain trading events where the parameters for stop losses and take profits can change depending on liquidity. That does happen. I'm not being thinking like if you got like euro dollar, what an average early morning, mid-afternoon plus NFP. NFP, yeah, okay, the non-farm payroll or any major market event, the parameters are likely to widen because most liquidity providers widen them. But during early morning and afternoon, if there's no major event, the parameters should be quite close. If it's for example, 2 times the spread, depending on the trading conditions provided by the LP, as in the people providing the rates, maybe that's a little bit too close, depending on the platform the LP you're using. Again, it depends on the contract size, of course. I mean, the example I did on my diary, for example, would be like 10, which is not 2 times, it's a bit too tight. The reason why obviously, not talking about NFP and major market events, they widen it purely because of the spikes and because of the misquotes they could get from the LPs. But if it's 2 times, so that's like, say 1.6, so you'd be looking maybe just 3.2, the chances are you would open the position, you'd be closed straight away and you wouldn't know what happened. So usually they can set the parameters a little bit wider than that. But again, I could look into this, into your account, and see what you've done. I can answer that question. Again, I need to really know what your strategy and your plan is though, Colin, how you do it, so I can have a little bit of an overview on that. And again, not give you advice, of course, but maybe give you some suggestions. Early morning, mid-afternoon, yeah, okay, you should be a bit tighter, but major events, okay. That's good. New strategy. Am I right? Are you more of a scalper, Colin? Do you like to get in quite quick, don't you? Currencies, excellent. Well, I'm a commodity and currency trader. That's the background I've come from. Gold, as I've always talked about in particular, because they're more liquid and fast moving, and there's always more opportunities. There's always opportunities for everything, but I tend to find that liquidity is better with the currencies. Yeah, good. I know, yeah. Have you tried the MT4 platform? Have you traded on that? I'm not saying that MT4 is any better than the Stratton trader or anything like that, but again, okay, you trade a Stratton. Okay, interesting. Who's your account manager, Colin? George. Ah, he's a good lad. He's a good man. You're in good hands with George. He is a good bloke. He is a good bloke. Okay, well, look. Obviously, I tend to deal with or talk to. No, he's very good. He's a good lad. He's Canadian, but we're forgiven. Sort of Canadian. Hope you're not Canadian. Colin, you in the UK, I hope. No, he's a good lad. He's very good. I thought you were a good lad. Me too. Okay, look. Obviously, I have a VIP department where I deal with some VIP clients, which had certain things, stuff like that. I will have a chat with George at some point. Maybe if you're free, perhaps we can have a quick chat, you and me. Give me a chance to have a look over your account and everything. So you get an idea of what you're looking to try and achieve and what you're doing. And then we can have a chat, maybe one-on-one, so I can get a better idea. If I can see the history of what you're trying to do and what you're doing and stuff, I can maybe be a bit more insightful. Because I don't see your account, I don't see that. I mean, obviously, with my VIP desk of individuals I deal with on a day-to-day basis. But I'm happy to spend a little bit of time and have a look. But that'll be good. I'll talk to George about that, definitely. But no, we'll have a look at that. I'm glad, well, I'm not glad, but I'm pleased that you're looking into currencies, because I think currency, again, look, here's the thing which my old mentor taught me in trading, etc. He said one of the most valuable things in trading, along with like risk management, a plan and strategy, but is an idea. Understanding maybe there is other ways to look at things, other opportunities. Long as you don't spread your butter too thinly, too thin, then clearly, obviously, there is, as long as you've got an idea of something you might look at, it might help. But that'd be good. Okay, look, I'll talk to George tomorrow. Perhaps we can organise something either later this week or maybe before next week's webinar. That would be good, Colin. Definitely. Did you enjoy tonight? Do you find it slightly useful? I know it's probably old rope for you. You've probably heard it before. As always. Oh, bless. It's always good to see you as well, Colin. It really is. It really is. But anyway, look, let me talk to George. Let me have a chat with him, and we'll organise something. And we'll go from there, definitely. We'll come up with some sort of overview, review, something like that, and we can go from there, definitely. Definitely. And maybe what we can do, perhaps we can screen share, and I can show you some live stuff, like how to draw certain lines on the live platform, just you and me. Perhaps we can do that as well. Okay, that'd be good. Very good. Okay, if there is any other questions from anybody, anyone else like to ask me anything? Anybody else like to ask me anything? In that case, I will end up by saying, Colin, we'll definitely have a chat with George. We'll definitely organise what we discussed and what we said. Can I do a special shout out to Colin, as always? Great to see you. Michelle, brilliant to see you as well. And thank you everybody else for turning up and spending these few minutes with me. I really value it, as always. I'll wrap up by saying, depending on where you are around the world, either a good morning, good afternoon, or good evening. Till next time, and indeed till next week, every single one of you, trade safe.